month ago, SEBI Chairperson Madhabi Puri Buch had raised this issue that the futures and options markets were surging. She was very concerned that the surge in the futures and options market would create some sort of a balance or an imbalance within the stock market, and that could have a larger ramification for all investors. Now, in the context of what she said, it's important to understand what the futures and options market is. For a lay investor, what are futures? What are options? Are they weapons of wealth creation or are they weapons of mass destructions? That's what we're going to look at in today's episode. But to start with, what are futures and options? Futures and options are a derivative instrument. Now, what is a derivative instrument? As the name suggests, the derivative instrument is an instrument which derives its value from an underlying asset. For example, a Reliance futures contract would be valued on the basis of the price of the Reliance share in the cash market. As the price of the cash market price, the regular price of Reliance goes up, so does the price of the contract or the derivative contract that it's based on. And when the price of Reliance goes down, so will the derivative price of Reliance also go down. So they have a symbiotic relationship, both going up and going down together. Similarly is the case for a Nifty 50 based derivative. It is based on the current price of Nifty and it will change according to the price that it goes up or goes down, as the case may be. So that is what we call a derivative instrument. Now, before we dwell into what are futures and what are options as an instrument, let us look at some of the things that we need to understand about derivative instruments, especially the futures and options. There are 5 things that we need to understand when it comes to derivative instruments. 1, these are contracts that are created for a fixed period of time. So they are limited for a certain period of time to which it applies to. Second, unlike shares, you cannot buy them in 1 or 2 numbers. You need to buy it in the lot at which it's created. So there is a lot that is available, and this needs to be done in conjunction with that lot size. The future price of derivative contracts moves in tandem with the price of the underlying security. As I said earlier, if the price moves up, the future contract price also moves up. The contracts are settled in a certain period of time. In case of stocks, the contract period can extend up to a maximum of 3 months' time. And in case of an index, it can go for a maximum period up to 5 years. So these are the contract durations to which at the end of that 3 months or 5 years, it needs to get settled. Now let us look at the difference between what is a futures contract and what is an options contract. A futures contract is a contract that gives the right to the buyer to buy a specific stock or an index at a future date at a predetermined price, or it gives a seller the right to sell a particular stock or index at a future date at a predetermined price. But a future contract needs to be settled in real terms. So at the end of the duration of the agreement, the contract needs to be settled by both the parties fulfilling their obligations. That's what a future contract is all about. On the other hand, the options contract is a contract which gives the right for the buyer and the right for the seller to do the transaction at a future date, but not the obligation to fulfill it. What this really means is that on the due date, they can square off the transactions without actually fulfilling their part. So for example, if I have agreed to sell a share on a given day in future, I don't necessarily in the options contract need to give the share at the end. I can give the difference in price and settle the trade rather than having to actually give the stock at that point in time. Whereas in the futures contract, you will need to in reality give the stock. So that's the big difference between futures and options. These trades are extremely important in the business of stock markets. There are 3 types of people who use these transactions. First up, Futures and options are a great tool for hedging one's position. We will look at real life examples, and through that you will understand what the concept of hedging is. Let us say one is a potato farmer and you're expecting your crop to be out in the next 2 months' time. But you fear that the current price of potato may not sustain for the next 2 months. You believe the price will soften in the next 2 months, so it is imperative to lock into that price. So what you will do is you will get into a futures contract to lock in the sale price of your produce, which is you will promise to sell your stock of potatoes, maybe 10 quintals, 20 quintals, at a future date, say 2 or 3 months down the line, at a prefixed price. This helps you get away from the volatility of the price for a small premium that you will pay for this transaction. This is one clear example of how one hedges one's position. Similarly, on the other side, let us say you're looking at buying a particular stock, and for some reason you believe that the markets are going to be going up quickly while your money will be available only 2 months down the line. Then you can again enter into a futures contract with somebody to ensure that that particular stock, say for instance HDFC Bank, which is currently trading at 1650, gets locked in for you at that price to be delivered 2 months down the line. So that you are not at loss tomorrow. Let's say HDFC Banks moves from 1650 to 1800. You are not at loss in terms of that appreciation. You have locked in the price at 1650 itself. That's another transaction that one can look at from a buy perspective on the futures contract. But in both these cases, if you didn't want to fulfill the transaction, and in the example, let us say you wanted to buy this stock at 1650, but you were not really interested in physically holding on to that stock, merely looking at the gain that you would make at the end of 3 months. At the end of 3 months, it is suffice if the counterparty, that is the other party to this transaction, settles at 150 rupees per share, which you would have gained. Like I said, the example, 1650 is the current price, and let's say 2 months, 3 months down, the price is 1800. So the 150 rupees of gain is all that the counterparty needs to settle to you per share of HDFC, rather than giving you the HDFC stock itself. So that is what an options contract is all about. So it gives you the value, but not necessarily fulfill in the transaction. So like I mentioned, the people who use F&O are large institutions. They will have to hedge their position. Let's say they have a large portfolio in stocks, and for some reason they anticipate some weakness in the market. What they would do is they will hold on to their positions in stock, but get into an options contract where they sell their portfolio to a certain extent. What this does is it hedges their position on that. And to that extent, if the market does go down, they will stand to benefit because they've hedged their positions to that extent. If the market doesn't go down and on the contrary it remains where it is, they have paid a small premium on hedging their portfolio to that extent. There's an additional cost they've incurred, and that's a cost definitely. But it has helped them stave away a large risk of the portfolio going down. Second is, there are lots of people who speculate on the F&O market. They are anticipating some big price movements either in the stock or the index in the next few months. Towards that, they are today either taking positions as a buyer or a seller with the idea to benefit from the future price movements. Now, these are people who are doing it purely from making a quick buck. And that is where I think Madhabi, Puri, Buch had a problem, in the sense that these retail investors who get into futures and options need to make sure that they are aware of the risks. Otherwise, they could blow a big hole in their portfolio pocket. Futures and options are definitely a great tool if one wants to hedge their portfolio smartly. But endless speculating, trying to make some quick buck on the F&O market can severely damage one's cash flow as well. So use F&O carefully towards enriching your portfolio is what I would recommend.